Up everybody, and welcome into today's video. We are getting into the loans that we use to complete our BRRRR transactions. These are the loans that we use for our cash out refinances, and pretty much what you need to know about these loans when you're shopping for these loans and the main components of these loans. I'm very excited to bring you this information because I got to tell you guys, the BRRRR strategy, the cash out refinance, has been the biggest moneymaker for us in our real estate business. We have made millions and millions of dollars, tax-free, I might add, doing the cash out refinance strategy. So this is very important information. I'm excited to bring it to you. If you're new to the channel, welcome to The Cream. The Cream is for cash flow, real estate, and money. That's what we're all about. We are full-time real estate investors. We've been full-time real estate investors for a long time. We are not new to this game. We have a very robust flipping company. We are consistently bringing in six figures every single month with our flipping business. We do a lot of novations and a lot of wholesaling in that flipping business. We got the receipts to prove it. And we own and manage a portfolio valued over $50 million that we have built brick by brick. We have built it with the same techniques and the same strategies that we talk about in our videos that we are doing right now here today. We are still acquiring rental properties, still flipping properties on the daily, and we are passionate about real estate. So if you're new, feel free to like the video if you find value in it, and make sure you subscribe to the channel to stay up to date. We're bringing in videos Monday through Friday, and then every single Wednesday we go live. So you can actually jump in the live stream Wednesdays at 11 o'clock Eastern, and you can ask us anything that you want. We're happy to help you with your real estate business, whether you're just getting started or you're looking to scale your existing real estate business. So let's get into it now here today. So we're talking about the loans that we use for our BRRRR deals or our cash out refinances. This is the final R in the BRRRR equation. The BRRRR is buy, renovate, rent, and then refinance. And I guess sometimes people put another R on the back and say repeat. And I agree with that. We need to be repeating this over and over and over again. But really, probably, the most important, or, where you're getting that cash out is coming from that R for the refinance. So the way this works here, everybody, is when we are buying these properties, we're using a private money loan, and we have numerous videos on raising private money. We're constantly talking about getting private money. That's for the acquisition and the rehab. After the property has been acquired by you, and after this property is fixed up, now it's time to refinance this property. And typically the refinance lender, they're going to want to see the properties rented out also. Okay. So once the property's been fixed, once the property's been rented, now it is time to get this property refinanced. So you're going to start shopping for a lender. The biggest thing that probably everybody initially asks about is, well, what are your interest rates, right? That's the first component of the refinance loan. I'm here to let you know, everybody, the rate is not going to vary that much amongst the different lenders that you talk to, right? It's pretty much going to be the same rate, very, very similar. I mean, if you talk to a couple different lenders and their rate is just astronomically higher than the others, well, obviously they're probably trying to skimp some off the top or trying to build in their fees and whatnot. You're pretty much going to see all lenders, they're offering similar rates, because at the end of the day, everybody, they get their money from the same source. They're getting their money from the Federal Reserve and from these, big institutions as well. Everybody's getting their money and kind of selling that money in the form of brokering out loans, right? So the rate is going to be pretty competitive across the board. But what you want to ask is about origination fees. This is where one broker could be different than another broker, because despite the rate being very similar, origination fees can vary from brokerage to brokerage, or from a loan officer to mortgage broker to a different mortgage broker. Pay attention and make sure you're just upfront and ask, what kind of origination fees are you talking about? And that is negotiable. A little bit, that is negotiable. And again, it's good to shop around. Make sure you stick around to the end of the video, because I'm going to share with you the most important thing to consider when you are shopping around for these loans, for these BRRRR loans, also known as DSCR loans, right? Which we'll get into. But origination fees, first off, you're going to ask about the rate. The rate's going to be pretty comparable amongst the various lenders that you're talking to. You do want to ask about origination fees. That's going to be important. That's money straight up coming out of your pocket. It's coming out of your pocket because they're going to work that into the closing, the HUD settlement statement. So instead of cashing that money out, instead of collecting that money, all the money that goes to fees is money that's not going to your bank account. So it is good to negotiate, but ask about origination fees, ask about the interest rate. And here's another biggie. You're going to want to ask about the LTV, the loan to value. So this is going to be pretty much standard across the board as well. You're going to find that most lenders are going to give you 75% of the after repair value. Now, sometimes on a larger loan, that loan to value will come down to 65%. And then in other instances, you will see some oddball lenders that'll go up to about 80%. But what you're going to pretty much be counting on and banking on, and really pretty much all the loans that we do, we're getting a 75% loan to value ratio. So that means if the property is worth $200,000 after it's fixed up, the after repair value, the lender is going to give you 75% of that, or $150,000 in this example. That's why when you are buying these properties, part of our buying formula that we talk about in these videos is we want to be all in to our deal, purchase and rehab, for 75% of the after repair value or less. Why? So when we go and get this refinance loan, the loan at 75% LTV is enough to pay off the private money that we used to acquire and fix up this property. And ideally, everybody, we want to be below 75% of the value, because that's where you're going to see your cash out. So if you're all into this deal with your private lender for, say, 70%, or say on a $200,000 house, you're all in for $140,000, 70% of the ARV, and the lender is willing to give you 75% of the ARV, or 150, right? They'll come in with the 150, pay off your lender of the 140. That extra $10,000, that is your cash out refinance money. It's a very rudimentary example that I'm giving you, but I'm here to let you know LTV is extremely important. If you're looking to pull out max cash, which I'm not opposed to, as long as you're not over leveraging yourself, get the highest LTV as you possibly can. And then you want to cash that money out and cash out that equity, especially if you're looking to build this portfolio. That's money you could use for operating. It's money you could use to get out there, use for marketing, to find more deals. The way we teach people how to buy houses, you don't really need that money for a down payment, because you're going to be borrowing all the money that you need to buy and fix properties. 100% of that financing is coming from private lenders. And then when you refinance these deals, right, you're going to borrow enough on the refinance to pay off that private lender, and then hopefully have some more there that you can keep for operating and really build your business, build your team. Use this money to invest is what we suggest you do. Create some cash flow streams in some way, shape, or form. That is how you're going to get rich at the end of the day. But that's where you want to do this over and over again. You want to cash out, do these cash out refinances. And even if you're just getting a 75% loan, you're not over leveraged. It's not like the house is worth 200, you're getting a loan for 240, right? That could be a pretty dangerous situation. But these 75% loan to value loans are very common. And if you bought the property right and your all in amount is below that 75% loan to value, then you're going to be able to cash out on the refinance. Rinse and repeat, baby. The example I just gave you has you having no money in this deal. You got 100% of the money that you needed for the purchase and the rehab, and then you got all the money that you needed on this refinance. You got more than enough money that you needed where you can actually cash out and collect money. So loan to value, everybody, 75% is really the most common loan that you're going to see out there. Sometimes that does fluctuate a little bit, but you can pretty much count on 75%. You're going to want to find out what this lender is lending at. So you asked about the interest rate, you asked about the origination fees. Now you're asking, what is the loan to value in your loan products, right? Another important one, everybody, is prepayment penalties. You're going to see prepayment penalties on these things. This is pretty much inevitable. And maybe, rates come down in your first couple years of owning this property, or maybe the property shoots up in value and you want to refinance this property. Well, you want to find out what type of prepayment penalties the lender is going to have. And that means if a very common prepayment penalty structure for a lender is going to be what they call the 5-4-3-2-1 setup. So this is where in the first year, where if you were to pay off this loan that you used to refinance in the first year, in 12 months after doing this loan, you're going to pay a 5% prepayment penalty. The second year would be a 4% prepayment penalty. Third year would be a 3% prepayment penalty. Fourth year would be a 2% prepayment penalty, and fifth year would be a 1% prepayment penalty. Because remember, these lenders who do this refinance for you, they want to keep that money in place. A lender only really gets good interest. They make a little bit on the origination fees, but they want the interest payments coming in every single month. So the longer they keep that money in place collecting payments, the more interest that they make. So if you pay it off soon and quickly, they build interest in there. They in the form of prepayment penalties. Look out for that 5-4-3-2-1 structure. It is what it is, everybody. If they have prepayment penalties, but they're giving you the best LTV, the best rate, and the lowest origination fees, you're probably going to do the deal. Don't let prepayment penalties deter you from getting a deal done, especially if it means paying off a private lender and getting a successful BRRRR deal done. You're probably going to have some prepayment penalties. It's really the least of your worries, unless it's some astronomical amount. I mean, chances are you're not going to be paying this thing off in the first couple of years anyway. And if it's a 5-4-3-2-1 structure, the fees just keep going down over time. 3-4 years from now, if you got to pay, 2-3%, something like that, but the property went way up in value, or you're lowering your interest rate drastically, it's worth it to do that, right? So pay attention to the prepayment penalties. You'll probably see the 5-4-3-2-1 structure out there. I wouldn't get too bent out of shape about it. And you're probably going to have these loans in place for at least a couple of years. So if that's the case, as the years go on, of course, the fees go down. So the final thing is, and then I will tell you actually the most important thing, is the DSCR. This is the debt service coverage ratio. And what that means is how much of the rent payment is able to cover the loan payment. Could be a little bit confusing, but a lot of lenders want to see a 1.25% debt service, which is the loan payment, coverage ratio. How much of the rent is able to cover the payment, right? So how much rent is coming in and how much of that rent payment goes towards the debt. So typically 1.25%, that means if the payment on the loan, on the refinance loan that they're giving you, let's just say that payment was $1,000 per month, and they require a 1.25% DSCR ratio, that means they want to see a rent coming in of at least $1,250 per month. 1.25% times the payment, or $1,000 a month in this example, would be $1,250 per month. So they want to see that the rent is sufficient enough to more than cover the debt payment that you're taking on for this loan. 1.25% is very common. And so basically that's how you look at it. You see what the payment is going to be. You can kind of guess what the payment is going to be because you know what the interest rates are. I mean, it's pretty standard across the board what the interest rates are, and you know kind of what 75% of the value is going to be. So you can get an idea on what the payment is going to be, and then times that by 1.25%, and you want to be dealing with properties that are going to more than cover that payment. And that's why you really want to be, and we're most bullish in our business and on this channel, with the affordable housing, right? The affordable housing, we love the houses valued really between 100, really there's not very much valued at 100 anymore. 150 to 250 is the wheelhouse these days, everybody. And that's where you could get sufficient rent to value ratio. You could bring in a sufficient rent to more than cover your payment on these refinances, you're not going to run into any trouble, or you'll run into much less trouble. On the high-end homes, you're not going to be able to hit that DSCR requirement. So stick to the affordable housing, but I don't want to confuse you too much when you're out there shopping for loans. Definitely ask about it, and that's going to let the lender know that you know what you're talking about a little bit. The final thing is this, everybody. What's the most important thing when you're shopping for a loan? The most important thing is the work ethic, and especially the communication of the person you're working with to get these loans done. I would gladly pay slightly more in origination fees or slightly more on an interest rate if I'm working with a stone cold hustler who's going to help us with these appraisal process and go to bat for us and just help us get these deals done. Nothing worse in life than a lazy person, as we all know. I know you're not lazy if you're watching this channel because you're out there building wealth with the rest of us here at the Cream. But it's the relationship and the work ethic of the person who's helping you get these deals done. You want a go-getter on your team, and they're going to be helping you. I cannot really express and share how valuable that is for you, right? The worst thing anyone could do on any team is just not communicate well. If this person doesn't answer the phone, you're going to need to find somebody else. There's nothing more frustrating in our business. I got some people right now that I'm waiting for calls back. I can't, it's just very frustrating to get these deals across the finish line. So make sure you're working with a hustler. Make sure you're working with a go-getter. Now, we do white label. We work with a company, Vontiv. We have Cream Funding. I will put the link in the description below. And if you use that link, set up an account with them. They're going to save you some money on the fees. So you do get a little break there. They're very competitive, and they offer every type of loan from new construction to refi BRRRR loans, and they even offer acquisition and rehab money as well. creamfunding.com. Again, I will put that in the description. That's it, everybody. Let's just summarize real quick. The interest rate, origination fees, loan to value, prepayment penalties, and then that DSCR, that debt service coverage ratio. Let me know in the comments about the deals that you're getting done, everybody. Don't slow down. Let's get after it. Right, we are still buying rentals. We got a rental closing this week. I've mentioned on yesterday's video. Cannot wait to share the numbers on this thing. RJ's working diligently on the rehab bid. We got to make sure we borrow enough to get these things fixed up. It's a very good deal, though. And then we got another one in contract that, you know what? I'm going to be calling a private lender as soon as I hang up on this video. And we got to get to work raising money on the next one we have in contract. But our goal, everybody, is to buy 10 rental properties every 90 days. That's the goal. If we can do that, we're building wealth. This is the highest wealth building use of your time, is building a portfolio, buying good deals, raising money, doing these cash out refinances. You will be rich beyond your wildest dreams if you do this, if you stick to the plan. And then, great way to do it and to be full-time at this, finding your next rental, is to continue to flip properties, do these wholesale deals, do these novation deals. That's going to keep bread on the table, keep food on the table while you are building a portfolio. The get rich slow and get rich forever program is the buy and hold. So make sure you like the video. Make sure you subscribe if you are passionate about real estate like we are. I'll be back tomorrow. In fact, RJ is going live tomorrow at 11. I will not be on the live stream tomorrow, everybody. I'm here in Florida for my daughter's therapy, and it is a busy, busy house from morning till early afternoon, and cuts right into that time. I would love to try to make it, but make sure you tune in every single Wednesday at 11 o'clock sharp. We're here to answer your questions. This is your boy, Dave P. I will see you all on the next video.